Interesting. All right, so I'd like to welcome our online audience. Thank you very much for being with us today. And without any further ado, I would like to welcome Professor Chris Ogbechi, who will give the welcome address for today's event themed Strategic Partnership and Alliances, Critical Factors for Moving the Financial Needle Forward. So Professor Christopher Ogbechi, over to you, sir. Thank you.
Thank you very much, and good morning, everyone, distinguished ladies and gentlemen, our audience, we are in the studio, and also those who are joining us online. I hope you can hear me.
We can hear you, sir.
Thank you very much. This year's conference is special, not because it's the 5th edition of the International Financial Inclusion Conference, but because of the theme. The focus is on strategic partnership and alliances, critical factors for moving the financial inclusion needle. And why do I say special? Once you mention the word partnership in Nigeria, it connotes so many things. Say how many partnerships have worked and how many are in danger of breaking up. This particular conference is being hosted again by the Sustainable and Inclusive Digital Financial Services Initiative here at Lagos Business School. But why should financial inclusion be of interest to us? Financial inclusion is a key enabler to reducing poverty and boosting prosperity, which is one of the key factors on the SDGs. But I don't want us to look at financial inclusion as just moving money. It has economic and social dimensions. And so we should see it as more of providing people the tools to help them transform their lives. If we see financial inclusion from that perspective, we find that many of us will actually show interest because it has economic dimension, it has social dimension. And what's the state of Nigeria's financial inclusion? We're not happy with where we are now. I think we can do better. Let's not forget that the CBN adopted the Nigerian Financial Inclusion Strategy in 2012. Although financial inclusion has grown in the past decades since it was adopted, we still fell short of our target of 80% by the year 2020. According to a final report, only 64% of Nigerian adults were financially included by the end of 2020. Amazingly, with about 52.5 million Nigerian adults living without bank accounts, again, a final report of 2020, Nigeria needs to scale its financial inclusion efforts sustainably and rapidly to meet the target of 95% in 3 years' time. That's 2024. So we are jumping from 64% to 95%. Is leapfrogging, and all hands must be on deck to make it happen. Because other African countries, particularly East Africa, and even Latin American countries have achieved this. And I believe we have what it takes to make it happen. And what is actually the motivation behind this, the theme of this year's conference? In the 2020 State of the Market report produced by here at Lagos Business School by the Sustainable and Inclusive Digital Financial Services Initiative, we found that partnerships and alliances are critical factors that can enhance product innovation, optimize resources, and improve digital financial services delivery at the last mile, which has been a big problem for us here in this country, making sure that we cover the last mile. These partnerships and strategic alliances have not emerged because of several challenges, including the limited capacity of the intending partners, inhibiting regulatory policies, and I hope the regulators who are here will take notes and see how they can soften the ground for us, and conflicting motivations and objectives of the partner institutions. If we are not all moving in the same direction, then we're going to have problems. So in terms of our motivations, how do we align them, particularly in getting these partnerships to work? In line with the mandate of our initiative here at Lagos Business School to support financial services providers to enable them to design and deliver products that improve financial inclusion for the unserved and underserved, this year's conference will explore strategic alliances and partnerships that can move the financial inclusion needle in the right direction. In conclusion, we hope that this year's conference will present financial services providers with frameworks that identify beneficial partnerships and strategic alliances that can significantly improve financial inclusion, especially at the bottom. This is an urgent call to action because COVID pandemic has demonstrated and has shown us that we need to collaborate more in order to solve our economic and social problems. I wish you all a fruitful conference. Once more, good day and welcome to Lagos Business School.
Thank you very much, Professor Ogbechi, for that very amazing keynote. Welcome address. As you said, it's definitely a matter of urgency, and attaining the financial inclusion goal that we have from 64 to 94% in the next 4 years is quite the challenge. And I think that it's going to be really a combination of private and public sector collaboration, market-led approaches, as well as government-led approaches. What do you think, Buffy?
Yes, I think that there has to be a strategic collaboration because from 64 to 94 is no small feat. So,
absolutely, no small feat at all. Thank you very much, Prof. Ogbechi, for that wonderful welcome address. And without any further ado, I would like to invite our second speaker who will give the keynote address, Ivo Janik, who's a senior financial sector specialist at CGAP. Ivo Janik, welcome, and please unmute yourself and kindly give us your keynote address. Welcome, and over to you.
Thank you very much, and a very good morning to everyone. I will use my presentation, so let me just turn that on.
No problem.
I believe it should be this one. So can you just confirm that you're seeing my slides now?
Yes, we can see your screen.
And are you seeing the main screen, or are you seeing the notes that say don't forget to say good morning?
No, we're seeing the main screen.
All right, wonderful. So do I have a full 2 hours for the keynote? Is it correct?
You have to.
Okay, all right. I'll try to be brief then. So, hi everyone. As I mentioned, I'm Ivo Janik. I'm senior financial sector specialist at CGAP, and I'm very delighted to be here. I'd like to thank the Lagos Business School for inviting me to this very important conference on this very important topic, and giving me not only opportunity to share some of the insights that CGAP has been working on, but also to learn from a very distinguished panelists and speakers that will feature throughout today. When I was preparing for this keynote speech, I was wondering what can I say to really inspire or convince those of you participating about the strategic importance of strategic partnerships and alliances for financial inclusion, because I believe many of you do have a direct experience with doing business in Nigeria and with the importance of strategic partnerships. So I decided to focus my attention and presentation on both practical examples of successful partnerships across Africa. So I'll give a few of those, but also on a broader trend that's happening and helping or reconfiguring the financial markets all around the world that, in my opinion, will force many institutions to reconsider really the importance of strategic partnerships, and will force them into partnerships as they go ahead and cope with the trend I'm going to talk about. So very briefly, let me introduce myself. I'm a lawyer by education. I spent 6 years at CGAP working on different topics related to new business models in digital financial services and also on things related to policy and regulation. I have a more diverse experience in financial services from my home country, where I worked across different institutions, including early in my career days working for a company called Partners. And so I guess there was something even early in my career that was already suggesting that I should be talking one day about the importance of partnership. Because in fact, in this company, which was a startup financial company, I very quickly realized the importance of partnerships and their potential for business, and I guess financial inclusion as well. I'd like to also say a few words about CGAP as an organization that I work for. CGAP is an independent think tank that is dedicated to financial inclusion. We're hosted at the World Bank, but we're effectively a global partnership of more than 30 different development funders and institutions. We are, as an institution, being shaped by the financial inclusion field in many different ways. We were launched or established in 1995 as an institution looking at the role of microcredit in elevating poverty. And then over the time, we sort of moved towards microfinance, mobile money, to embrace finally the notion of digital financial services and financial well-being in the digital age as of today. Our vision is a world where poor people, especially women, are empowered to capture opportunities and build resilience through financial services. And I think in this very vision, the notion of financial inclusion and the way we understand it is really embedded. And so allow me to say a few words about how we at CGAP think about financial inclusion, because I think it's very important to mention it in the context of this presentation. For us, financial inclusion is a situation where individuals and businesses have opportunities to access and the ability to use a diverse range of appropriate financial services that are responsibly and sustainably provided by formal financial institutions. And this definition really dwells on three important pillars of financial inclusion. The first one is access, making sure that low-income customers have financial services at their proximity, convenience, and those services are affordable to them. The second pillar is usage and use, making sure that those financial services that are offered are meaningful to the low-income customers and they respond to their very specific needs. And the third pillar is quality, making sure that those services that are offered to low-income customers are transparent, reliable, and delivered responsibly. And so it's not only about improving access to formal financial services, but also about those two other important components, use and quality. And this is important because we've seen that in terms of access, financial inclusion has been on rise all over the world. Between 2011 and 2017, 1 billion more adults got a formal financial account, which translates into 18 percentage points increase on average globally, and 21 percentage points increase in developing markets or economies. So that's significant progress, but this progress is not matched by the same level of increase in the usage of accounts. In fact, the whole 1/4 of all financial accounts in developing countries are inactive. And progress on other financial services and products, not only payments accounts and payment services, is lagging behind. So we don't see the same improving numbers around savings, credit, or insurance. And perhaps most importantly, 1.7 billion adults still remain unbanked or financially excluded. So we are obviously asking, who are the unbanked people? And here is a very quick overview. 56% of them are women. In fact, there is a 9 percentage points gap, gender gap around the world between men and women when it comes to access to financial services. Half of them live in the poorest 40% of households within economies, and we would see probably a significant number of them living in rural areas. 62% have a primary education or lower. 47% are out of the labor force, and nearly half of them live in just 7 economies, including Nigeria. So indeed, it's a big task that Nigeria has had in bringing those many people into the formal financial sector. By the same token, we should be also asking why those people are unbanked. And here's a snapshot of a survey asking people why don't they use financial services. And you see that the first 3 reasons are somehow related. People don't feel they have enough money to use financial services. They feel they don't need financial services in the first place, and they find financial services too expensive. So all of these are related. And in my presentation, you know, I think some of those trends or some of those reasons can be addressed through partnerships, but we should acknowledge that not all of them would be, and a broader effort is needed. And sometimes some of those reasons may not even be addressed directly by financial service providers or regulators, but would require a more broader initiatives and interventions. So let me now focus on the very topic of this presentation, which is the role of partnerships in advancing financial inclusion. And I'd like to start just very briefly, and that might be just the lawyer in me, you know, defining what we mean by the partnerships. I think it's important because I personally sometimes struggle when I read about the partnerships. And even if you open the news today and you get to the page that talks about financial sector, you'll probably find a few announcements here and there about new partnerships being formed and you know, partnerships leading to this and that success. But sometimes this term is used interchangeably with the notion of commercial relationships, such as B2B or outsourcing. And so I think it's important to highlight what really sets partnerships apart from those other types of commercial relationships that we see out there. And to me, the key definitional factor here is the notion of shared destiny. Partnership is an agreement among parties to share destiny and future success or failure, which often translates legally in a shared revenue model. And so these are the partnerships that I'm going to talk about. And I think there are essentially 2 driving forces behind partnerships, the reasons why partnerships are formed in the first place. First, the perceived opportunity where the partnering parties believe that only together they can achieve something better, they can create a new quality and improve their business, or the necessity. And so I will first talk about the opportunity very briefly and give those few examples that I mentioned earlier. But then I would like to focus more on why I believe it is actually becoming increasingly necessary to think about the role of partnerships for the financial service providers, the incumbent ones or the newcomers. So here, let's talk about one example of where a partnership is driving financial inclusion. The example that's probably very, very well familiar to most of you, and that's the case of M-Shwari, where CBA and Safaricom partnered in Kenya to deliver a combination of a savings account and digital credit, using sort of the superpower or super capability of Safaricom as a mobile money operator to deliver, to use the distribution network and deliver services on the ground to their many clients, and the regulatory capacity and the balance sheet of the CBA to deliver a credit and a saving product. And this has helped the partners to create a new quality for their clients, which is that combination of savings and digital credit. And it also obviously helps so bringing a really new financial inclusion related quality to the clients. It's the deepening of financial inclusion that I was talking about, improving the usage of the accounts. But it also brought a new quality to the partners in terms of the revenue sharing model. The other example I'd like to mention very briefly is Jumo. And the reason why I'm presenting Jumo this way, sort of against the backdrop of the M-Shwari, is because, you know, in sort of, if we simplify, this is what Jumo does. Jumo takes the model of M-Shwari in a way and simplifies it and packages it and allows all sorts of banks and mobile money operators across the markets where they operate to do a similar thing, to create a M-Shwari like product. So it's again very much based on the notion of partnership that's behind the Jumo success. And then the third example I'd like to give is TimeBank, a South African digital challenger bank, which has onboarded 4 million customers since their launch in 2018 for the cost of only $3 per customer and in less than 5 minutes per each customer. And this, success in terms of lowering the onboarding cost and shortening the onboarding time is also due to the partnership, because how they onboard most of their customers, 85% of the customers are onboarded through a kiosks, ATM-like machines that are designed for automated customer onboarding that are placed in the partner stores of Boxers and PNP, which are nationwide grocery stores in South Africa. And this not only helped them to reduce the onboarding costs, but also to reach out to customers living in different areas, perhaps beyond what branches would be able to help them to reach. Plus, the cost of running this distribution network is estimated at around 4% of what is the cost of running traditional bank branches. So with the timing, I'd like to kind of segue into a bigger picture of new business models that we're seeing that are very much relying on partnerships, or where partnerships are one of the key definitional features. And so here is, the three business models that we've identified in digital banking. TimeBank represents the fully digital retail bank on the very top. But we also see two other distinct models in banking, which is a marketplace bank and banking as a service. And both of them at the center have partnerships. Marketplace bank is an effective business model that emulates the e-commerce approach, where a bank creates a marketplace of financial services and products as a one-stop shop for the customers. But those products are not all delivered and offered by that very bank, but can be also offered by partner institutions that just market their products on the marketplace. The other example is a banking as a service, which is basically a tech company with a banking license that represents the vision of banks as a market utilities. And again, banking as a service providers, they actually use partners to create their value proposition, to create a superior technological stack and integrate those partnership value proposition into their platform, which is then offered to clients of banking as a service providers, be it banks, be it fintech companies, be it other providers. So this is a segue into the second sort of part of my presentation. And this presentation is about the bigger trend that I was referring to initially, modularization and embedding on finance, something that's happening and that is, I believe, making partnerships a necessity, not only an option. So what I mean, or what do we mean at CGAP by modularization and embedding of finance? We see that the traditional model of vertically integrated financial service providers, traditionally banks that offer everything from payments to wealth management services, this model is being disintermediated, if you will, by the fintech trend. And so what it means is that now the clients don't need to go to one single institution to shop for all sorts of financial products, but they can select from a wide variety of providers, very often very specifically specialized on one task that they master, and offer a superior solution to the customers. So this creates a new situation where there are no longer those vertically integrated institutions, but rather hundreds and thousands of highly specialized providers that customers can choose from. And this is due to so this is what we call the modularization of the financial services. And this is due to technological advancements that we've seen over the past 10 or so years. The emergence of cloud computing, the APIs and open APIs, service, software as a service, AI and machine learning, and so on and so forth. So this technological advancements allowed a big part of what we see and can label as modularization. But it's also the fact that there has been a significant drop in the cost of launching a tech startup from $5 million in 2000 to $5,000 in 11. And this significant drop in launching cost has been matched by incredible increase in the investment that goes into fintech companies, from $45 billion in 2014 to $215 billion in 2019. So this creates an absolutely unique circumstances that promote a development of fintech companies, that promote innovation, and that definitely fuel the trend of modularization and embedded finance. And this is a really global phenomenon, as suggested by the mix of firms that really come from all corners of the world and that are used as illustration on this slide. Now, what is more important, or perhaps as important, is that this modularization is not only happening at the individual institution level, but it's also happening at the market level. So the market structure itself is becoming modular and is reconfiguring along 4 key layers: the balance sheet layer, product layer, customer relationship layer, and distribution layer. And again, those 4 layers would traditionally be delivered or sort of controlled by a single institution or single holding company. But now we see that those layers are actually taken care of and posed by different providers. So what it means, let me give you one specific example: Shopify. Shopify is an e-commerce platform operating internationally that you also offers to their customers some financial services, such as payment services and wallet. So they are in control of the customer relationship layer and the distribution layer. But when it comes to the financial product, that is curated and delivered by Stripe, their partner. And if we look further, Stripe is in control only of the product layer, because the balance sheet layer, that is where the actual money sits, the money of the customers of Shopify, is controlled by partner institutions such as Goldman Sachs or Citi. And so when we talk about the modularization, this is precisely the situation we're talking about. There are those different layers that are controlled by different institutions, and those institutions operate in a partnership. And that's the reason why I'm talking about it. It's also a good illustration about of the concept of embedded finance, where financial services are delivered in a context that is not specific to financial services. Customers are coming to Shopify to purchase goods and services on their platform, but embedded in that value proposition is also a financial service itself. So this trend of modularization and embedding finance creates an opportunity and, again, a necessity for new types of partnerships. On my previous slide, we see a couple of logos and a couple of different institutions, and those institutions do operate as partners. What is important to note is that those partnerships that are emerging have a new quality to them. And that quality could be described as they are customizable, flexible, and plug and play. What it means is that those partnerships are no longer rigid. They actually allow the partners to be agile and very responsive to their customers' needs, to the market circumstances, to how the partnership evolves, what kind of technology becomes available. So they're scalable up and down. They are very responsive. They allow for agile product development. And it is kind of a new quality that really describes and sort of encapsulates the key feature of those new partnerships driven by modularization and embedded finance. Now, you can say that this is all cool and very interesting, but the very purpose of this conversation is not to talk about big macro trends, but rather what is the impact on financial inclusion. So how this trend of modularization and those new partnerships and strategic alliances that are driven by this trend can help to advance financial inclusion. Well, we believe that it can across multiple dimensions. First of all, those partnerships help to reduce cost, because you have partnerships of highly specialized niche providers who really master their value proposition, who really optimize the delivery of their value proposition to the extent possible. This should be driving the cost down, and this cost saving should be passed on to the customer. So when you think about the example I gave, the time bank, for example, because their distribution network costs them 4% of what would cost them to run a branch network, that allows them to expand their services and serve a wider customer segments, including the low-income, underserved, and unserved customer segments. Access, it should improve access as well. And again, think about the time bank and the alternative distribution model they're using with the kiosks in the grocery stores. This is expanding access as a direct result of the partnership that they form. Fit, it should improve the fit of the product, make it more relevant. And you can think of the example of Ameshwari. The partnership really created a new type of product that better caters to the needs of the customers. And it should also improve the experience of the customers, providing superior UX UI design, or just focusing on that very specific niche delivery that is embedding finance in a broader value proposition, as we saw, for example, in the case of Shopify. So yes, we believe that partnerships, alliances, and the trend of modernization can help to improve financial inclusion. Now, I'd like to conclude with a few points about first summarizing what I just talked about, but also maybe reflecting on what it may mean for in the case of Nigeria. So I try to demonstrate with practical examples that partnerships help to seize opportunities that advance financial inclusion, and there's evidence that that's what's happening. I also wanted to provide a case that there is a broader macro trend of modernization and embedded finance that's driving the need for partnerships. Because if the institutions, the financial service providers, do not really react to this trend and do not start thinking about strategic partnerships, they may be very easily disrupted and maybe even replaced by other players, newcomers, or even new types of entities such as big tech platforms and super apps like Google, Uber, Bolt, and others. So what could it mean in Nigeria? It's really a question for all of you. From very little I know about the country, I realized there are probably 4 important barriers to financial inclusion. It's a limited access to formal financial services, especially in certain areas and for certain customer segments. It's a limited ID coverage that limits the access to financial services because of the KYC requirements, limited product offering, and perhaps low awareness among customers. And all of these points can be solved through partnerships. And here are some examples. Institutional exclusion can be solved through the agent networks and other alternative distribution channels. Limited ID coverage can be solved through the partnerships and collaborative customer due diligence. Limited product offering can be solved through the marketplace approach that I talked about, where institutions partner together and create a marketplace of financial services. And low awareness, perhaps through the partnering with community, civil society, and NGOs to raise awareness of the utility of financial services. So with that, I'd like to again thank the organizers for having me and giving me this opportunity. I'd like to invite all of you to visit cgap.org/fintech, where you can find more about what I was trying to cover in a short time here in my speech. And thank you for your attention.
Thank you very much, Mr. Janik, for that wonderful and timely address. We really learned a lot from what you said. I love the fact that you spoke about financial inclusion from the perspective of those at the bottom of the pyramid, but as well, you talked about fintechs, and you also broke it down as to how it pertains to the Nigerian market. So thank you very much for that presentation. Without any further ado, I would like to welcome Dr. Nkemdilim Iheanacho, who will give the presentation of highlights from the 2021 State of Markets report and report launch. As many of you will know, this is a report that comes out on a yearly basis. And we're essentially here to give you the highlights of that report for the year 2021. So Dr. Nkemdilim Iheanacho, thank you so much for being with us. And over to you with the report highlights.
Thank you so much, Lily. It's indeed a great pleasure to be with you all. It's always a delight, always an honor and privilege to present our State of Market report on the practice of digital financial services in Nigeria. I'm going to be presenting to you here highlights of this report that catalog all of the work that have been done in the Sustainable and Inclusive Digital Financial Services Initiative, authored by a good number of the colleagues and members there. Of course, the authorship was led by Professor Olayinka David West, who will be joining me shortly to launch this prestigious report. Now, the theme of the 2021 State of the Market report, which is going to be the first of its kind, is on partnerships and strategic alliances. Following from the presentation made by Evogenic from CGAP, we can clearly see and understand that digital financial services are structurally complex, as a result of which it becomes difficult or even impossible for a single organization to have all the skills, all the resources, and all the capabilities that will be required to effectively design and deliver this product. Essentially, the focus of this report, which is the first of its kind, with a focus on partnerships and strategic alliances, is to understand the impact of these partnerships and alliances on how digital financial service products are designed and delivered. Now, this report has 3 sections. The supply side insights section that speaks a lot to the capabilities and the resources the financial service providers, as well as all the other accompanying institutions, deploy in partnerships and how these resources help them create the products. The second section speaks to insights from consumers, and the third section speaks to regulatory highlights. The supply side insights. The supply side insights, first of all, starts by highlighting the dominant partnership models. So you have the revenue sharing model, you have the fee-based model. Now, also, this section highlights critical success factors that make it possible for financial service producers to consummate and deliver partnerships. Track record, what's their experience in delivering these partnerships? How has the institution evolved? To what extent are financial service producers able to align their goals with the goals of their partners? And how do all these goals help effectively contribute towards creating these partnerships? You have several other critical success factors that are highlighted in this report. And what's more important are that these critical success factors are the types of success factors that the producers should pay very critical attention to if they would succeed in these partnerships and if they would ultimately achieve their goals in delivering these products. The section also highlights in great detail enablers and inhibitors of partnerships, partnership initiation processes, partnership lifecycle framework. Now, a very important part of this report also provides tools and frameworks that would help financial service producers manage the entire life cycle of their partnerships, from partnership initiation to partnership evaluation to goal alignment and goal congruence, and even to helping financial service producers think critically about the partnership processes they would undertake in creating digital financial service products for their consumers. Consumer insights. The consumer insights section actually dwells on product opportunities and interventions for focus segments in the financial services space. The 3 focus segments we actually dwelt on extensively in this report are the rural dwellers, the women, and the youth. Now, the populations of these 3 segments are also highlighted, the excluded population specifically. We also went on to highlight some product opportunities across savings, across liability generation, across insurance, across pensions, across investments. And then we also highlighted some specific interventions. For instance, the rural dwellers would benefit immensely from low-interest agricultural loans. So across all these stratas, we have financial literacy, and then products also targeted at financial service agents. Regulatory insights. Now, the section on regulatory insights highlights policies and first of all speaks to alliances amongst regulators. So amongst the regulatory space in Nigeria, there are multiple alliances across agencies where these agencies come together to better coordinate their regulatory function and ensure that the stakeholders, the operators, as well as the Nigerian people are served and have policy choices that ensure that the producers and the other implementing partners in the ecosystem are able to effectively work. So we have interagency meetings, we have joint committees, regulators frequently bring out draft exposures of their regulations and make these available to other stakeholders and other agencies for review and feedback. There are multiple roundtable stakeholder engagements. You also have interagency MOUs, guidelines, and regulations. Now, these are on the structured areas. Now we also have the informal, the quasi-legal types of alliances where informal conversations and informal engagements typically happen amongst the various regulators, and all of this help in ensuring that there is better cohesion, better coordination, and better alignment at the regulatory space, with the aim of ensuring that these producers are effective in creating these products. We also have inhibitors to strategic alliances amongst regulators. So we have things like internal reorganizations within agencies. Lots of the agencies need to also go back and look at how their structures reinforce, coordinate, and ensure that there's that alignment and unity of purpose across each of the regulatory mandates all these regulators deal with. Lack of adequate succession planning. So when an officer occupies a desk and commences the initiation of an initiative, how do we ensure that upon the officer's retirement, resignation, or reassignment, the next officer who takes over is able to still carry on that mandate with the same level of intensity and with the same commitment and passion to the goals? We also have power tussles, where regulators are sort of asking who is in charge and who has the sole mandate of delivering on this goal for the government. Policy discordance, this happens where some policies work at cross purposes. And then we also have regulatory overlaps where single functions are regulated by 2, 3, or 4 regulators. And the confusion now becomes who is actually in charge, who is giving the license, who has the authority or the authorization to give the penalty, etc. So all of these inhibitors we've highlighted in the report need urgent attention if we're actually going to achieve the goals and objectives stated in this report. In conclusion, this first of its kind state of market report is loaded with insights, loaded with tools and frameworks that will directly help operators understand the dynamics of partnerships, with insights as to the problems current operators have, with also nuggets on product development opportunities within the financial services ecosystem in Nigeria. And our expectation back here in Sustainable and Inclusive Digital Financial Services Initiative in Lagos Business School is that this report would help you build alliances that would, first of all, unlock those hidden opportunities, help you assess new segments, acquire new customers, create the right types of customer experiences that would ensure you're able to onboard millions of Nigerians that have been unserved and underserved, and many more benefits. I strongly encourage you to download your copy, grab your physical copy, and get on with the show. At this point, I would call on my colleague, Mr. Timothy Aluko, the Program Manager in Sustainable and Inclusive Digital Financial Services Initiative, and also I'll call on our one and only Project Director, the lead author of this report, and the head of the Sustainable and Inclusive Digital Financial Services Initiative, Professor Lainka David West. Okay. Wait. Thank you.
Thank you, Dr. Iheanacho, for that insightful session on the state of the market report. Now we're moving on to the Fireside Chat. The Fireside Chat series digs into the success story of businesses from diverse industries who have served the mass market for many years. So at this point, we'd like to welcome Professor Olayinka David West to moderate this session.
Thank you. Thank you. Hello, and from wherever we're dialing in from, good morning from Lagos, Nigeria. It's nice to be here once again to share insights and perspectives on financial inclusion in Nigeria. And at SIDFS, we don't only share the numbers, but we also share insights as to how we can change the perspectives and move the needle. So this special session on section on partnerships this year really opens up a Pandora's box of what we need to be doing around getting our financial services providers better geared up to reaching the bottom of the pyramid and to moving that needle. So as we know this year, we're still struggling with financial inclusion. The FINO report was launched earlier on this year, and also we're still waiting for the Global Findex results from the World Bank. But we feel at SIDFS that this is one of the conundrums that financial service providers are challenged with, because when you look at several of the issues that in the report mentioned, we have the partnership, different partnerships models. And so when you look at some of those models, they're embedded with different considerations across every phase that need to be understood properly. And then when we think about financial inclusion, we also need to be mindful that there are many stacks involved in the delivery process. We need to think about the infrastructure stack. We need to think about the literacy and the education stack, because one of the things Ivo did point out was the fact that there is very little awareness about financial inclusion and mobile money in general. Then we think about the technology stack, the products and services stack, as well as the agency stack. But bottom line is that we need to really think about the partnerships, because one of the critical issues regarding financial inclusion in Nigeria is affordability and cost. So how do we use a lot of these relationships and engagements to ensure that we can actually transfer lower costs to the providers? But then in doing so, we also want to de-risk the products and services, as well as enhance economies of scale and scope, and enhance the customer experience, which is ultimately a key issue. So this morning or this afternoon, I'm joined by, I would call Major Ashisha Huja our friend. And I'm calling Major our friend because, you know, earlier on this year, we had a series of engagements regarding the payment service bank license frameworks within Nigeria. And Major was a great resource to us in his own experience working with Fino Payments Bank in India, where he leads as the Chief Operating Officer. And one of the things that has changed, Major, since we last spoke was the ecosystem changes that we see. 2 of the additional telcos in Nigeria have been granted approval in principle licenses for payment service banks. And then, as you know, Nigeria also launched its own first ever in Africa central bank digital currency called the e-Naira. So we hope that these 2 movements and these 2 shifts will also come into our own ecosystem and change what we see in the DFS space. But then again, one of the things we want to have a conversation about this morning, Major, is building on from the discussions we had earlier on in March, which is your strategy of DTP, right? And DTP, for ladies and gentlemen, for those of you that don't know, were not with us earlier on in the year, it stands for Distribution, Technology, and Partnership. And these are some of the principles of Fino Payments Bank within their digital strategy. And Fino Payments Bank is one of the payment banks in India, or the only payment bank in India that has actually broken even and has reached that profitability point. And that is also because the permissible activities of the payment banks in India are similar to what we see in Nigeria. So they can't lend, and they do, you know, they have different services. But the Fino Payment Bank also has 34 million customers that they're serving and over 800,000 customer touch points. So Major, I think it's only nice that we learn more from how you're doing this And I know that the partnership, the P in the partnership is a critical area of your own business model and the principles that drive what you do. So I'll just start the conversation. And the whole idea of this is really to share your own perspectives on how partnerships have worked for you at Fino and how they've helped you build your market and grow that market space in spite of the limited activities that you can provide within the banking system. And I'm going to draw that on Ivo's presentation of the layers and the stacks when you call the balance sheet layer, because that's the layer the Reserve Bank of India is also trying to protect around balance sheet lending, etc. So let's start and just, so India is different from Nigeria, Major. And I think the first thing is that just tell us what happens in India, what's the regulatory landscape like in India, and how do we sort of now begin to draw analogies from the context in which you're operating in? Thank you. Go ahead.
Thank you so much. And firstly, Professor Yinka, thank you so much for having me on this panel. Thank you to your team. It's truly a pleasure and honor to be here back again amongst all of you. And very, very delighted to hear the environmental changes that have happened in the financial space in Nigeria since we last met. That's really nice. Thank you so much once again. To come back to your question in terms of the regulatory landscape, so let me put it this way. Till about 2015, there were only a set of banks in India which used to be called the scheduled commercial banks, and with which you had a couple of variations like cooperative banks and regional rural banks, which had different mandates. Thereafter, there was a paper written by Dr. Nachiket Moore. At that time, Dr. Raghuram Rajan was the governor of the Reserve Bank of India, and a differentiated licensed banks were brought in, which were two types. One is payment bank, and the second is small finance banks. Fino happens to be one of those payment banks which applied for the license and was duly accorded one. Now, coming to the payment bank space, what is it that differentiates us from others? The first aspect is that a payment bank can take no credit risk on its books, so hence you have no balance sheet risk in terms of lending. Second aspect, the day-end deposit in any account of a customer at a CIF level, at a customer level, he or she may have multiple accounts, cannot exceed 200,000 INR, which is broadly in the range of about 2,500 USD, right? Third aspect, whatever monies that get deposited by customers can only and only be invested 75% into government securities and 25% into fixed deposits with scheduled commercial banks. So that's the third aspect. The fourth to this thing is that in terms of time deposits, there are no liability time deposits. There are no time deposits, no overdrafts, no recurring deposits, no fixed deposits. These are not allowed in terms of the whole advent was that this segment of banks would operate on a light and digital model, asset light, and serve a underserved customer. Because then I think in a country like India, because of Jan Dhan and the various initiatives taken by the government, there would hardly be anybody who would not have an account. Question is the account serviceable? Is the customer getting the service that he or she desires? So in larger sense, these are the 4 or 5 variables that were laid out in terms of, I would say, the restrictions on the license. But alongside what was allowed is that you can go and partner with any scheduled commercial bank to bring in, or with non-banking finance companies, and do third-party products through them, so that the risk, direct risk, is not on your balance sheet. You are running a referral model in which maximum you would have is some sort of operational risk. Back to you, Professor, in case that answers that part of the question.
Great, thank you so much. So what we're hearing is that the licensing framework, while it restricted and limited you, it also opened up the possibilities of a referral model, which is through partnerships. So you could partner with different bank and non-bank entities to expand your product set. So tell us a little bit, what types of products have you built out using this referral model?
So if you look at the biggest advantage of being a regulated entity is that you have complete ownership of the customer. Fino, prior to coming into a payment bank as an entity, used to be a banking correspondent or a business correspondent and used to service banks. Now, We continue to do that because as part of the licensing guidelines, I am still allowed to be a business correspondent to another bank and allowed also to appoint business correspondents as part of my distribution setup, right? By getting complete ownership, we decide the product, we decide the process, we decide the entire flow. So there is an end-to-end ownership on the customer that we get. In terms of product lines that we would have, that we've launched in terms of the main product lines, one is current account and savings account. In that also, we've got about 14 variants today of our current and savings account. But the major thrust on all our product lines is that we've gone for sachet products, or what we call the Netflix type of products. They're all subscription products. This segment of customers, and these are typically people who would earn anywhere between about 150,000 INR to about 700,000 INR. So you can say about about 1,250 USD to about 7,000 to 8,000 USD a year, right? Now this customer segment is some person who doesn't like surprises, doesn't like hidden charges. So we said, let's make it very, very transparent and tell the customer that you would need to pay us. We charge 449 INR per year for the savings account. So that's broadly in the range of about, I'd say about $5, okay, for the year. We give them a very high transaction throughput. We give them a very high value throughput. We give them over-the-counter debit card. And this is a renewable feature year on year. For the customer, it brings in a very, very transparent pricing, easy to use product where tomorrow there are no minimum balance. We don't expect any minimum balance in the account. We leave it to the customer. You want to keep zero, you want to transact in the account. So in that sense, in all this, we try to go back to the customer and understand what is the need of the customer. And we also evolved. We started with very standard accounts. We realized in the first 2 years itself that this is not going to work for this customer segment. So innovation was the key. Our second aspect, we open approximately about 200,000 accounts per month, and 85% plus of these accounts are all our subscription-based saving accounts. On the other side, we have domestic money transfers. We do broadly in the range of about 4,000 crore INR on a monthly basis in terms of throughput. We are the 4th largest player in terms of domestic money transfers in the country. We do cash withdrawal products, which is micro ATM. A micro ATM, if I can show you, is something that looks like this. If you can see this.
Yes, you can see that. Great.
So that's a micro ATM. Now imagine it does the same work as an ATM. An ATM costs you anywhere up to about 4 to 5 lakh INR is the cost, and an operational cost of running it, air conditioning, guard, cash replenishment, everything. This machine works on the same rails as an ATM and does the same job. And the cost is as low as 4,000 INR of this machine, which is broadly in the range, I would say about what, $20 odd, about $30, I would say, $30, $35, right? Now, here we do broadly in the range, we've got a 55% market share on this side, on this product alone. And we do a throughput of approximately about 2,500 to 3,000 crores on this product. Because we said, let us take something to the market which can be used by the agent. So in this case, a customer of any bank comes with the debit card, withdraws money, and the agent, my partner on the ground, is giving money out from his vault or his drawer to the customer, and I am replenishing that in his account instantly on a successful transaction. So you've kept cash in the local economy, you've taken away all the requirements of a space, of air conditioning, operational expenses, cash replenishment, all that goes away. And the service level is similar to that and much better because there is no timeout. These are shops. The distribution setup is all mom and pop shops. The D, T, and P, the D part of it is what? Mom and pop shops, mobile repair shops, mobile galleries, Xerox copiers, stationery shops, chemists, anything where there is a high propensity of footfall happening for your earlier business, we target them as merchants. This financial services brings in incremental footfall. It's a win-win situation for both. You had 50 customers coming in, you bring in financial system services, those 50 get financial services. But the financial services, another, let's say 20, 30 customers, those customers will probably start buying bread, eggs, getting a mobile repair, whatever is your core job of this thing.
Great.
The income earned accentuates the income of that merchant over and above what his normal profile of work is.
Okay, great. Thank you, Major. And I think that you've actually said quite a lot in this. And one of the things is, first of all, the transparency, which is trust building as well, because that's foundational to the group of customers you're trying to reach. The other is customer centricity. Use innovation to drive and build the fit around what the customer needs, not around what you want to produce. And I think the most important is also your cost to serve model, keeping it as low as possible to ensure that those costs can be transferred to the customer and they're not inhibitive to the customer. But so I think what I take away from this is this whole idea of what you called it in the Netflix model. So one of the things I want to segue onto is something that Ivo started talking about in his keynote, which was really about the unbundling of financial services and banking. And that's a critical thing, because one of the things we see is that we're used to these monolithic entities known as banks, right? And now we're beginning to see the functions of what banks typically used to bundle together performed by different entities and different actors. And I think that's also one of the things that you're leveraging on at Fino. So how do we continue to build this synergy? So can you just tell us, so you now have 34 million customers, 800,000 plus touch points, and some of those touch points are these mom and pop shops that you've mentioned, where you're leveraging their existing presence, the existing footfall, and say, no, we'll give you do some financial merchant acquisition services, and you earn some more money. So tell us with examples, if you don't mind, how has this played out in building these synergies?
So let me try and explain to form. The biggest example of synergy is one of our largest investors, Bharat Petroleum Corporation Limited. It is one of the largest oil marketing companies of India, and they hold a strategic stake in, they're a strategic shareholder in the bank. When I look at it, why did Bharat Petroleum come and do a strategic investment into the bank? That's an oil marketing company. 15,000 plus retail petrol pumps, 5,000 plus gas points, where you, cooking gas points, right? Now 20,000 branded points which are available to Fino, where all Fino financial services are offered from. What did that bring as a synergy? Bharat Petroleum carried out a dipstick survey. Petrol sales in states where the survey was carried out increased by 7% after they brought in financial services being offered from the same point. Because people who came, and this is more, I would say, a tier 2 and below kind of a phenomenon. Metro is naturally lesser because people are spoiled for choices. Is people coming to buy oil, lubricants in this thing, get to carry out financial services right there and then on the spot in a very congenial environment. And hence, a win-win situation for both sides. So what do we look at? From a partnership perspective, whenever we step out, we say there needs to be synergy of a common goal between the two entities. For me, I have financial products, so I would look for entities with large distribution setups. These large distribution setups mean that my financial products can be vended over there. The other side I look at is to say the products that I do not have on my own, which are the kind of entities can I partner with? Insurance, a perfect example, where we partner with different types of insurance companies, both on the health and general insurance side. Secondly, on technology, the T of the DTP, we partner with various startups and various fintech players and technology service providers to enhance that. Just do it by yourself is not a culture. So when you build alliances, when you build partnerships, please look at it as not as a one-off project. You need to build it as a culture. Otherwise, that synergy will only be for a one-off project rather than as a culture in the organization.
So basically, Ashish, it's really about that should be part of your underlying organizational DNA. But one thing that struck me from what you said is that you had the relationship with the oil company, and that you're seeing a lot of transactions and around the petrol station. But then again, I now go back to what we just said about the monolithic bank and that monolithic entity. So it just means that people want to be served in places that they're already going to, and they want complementarity of services around the existing lifestyles rather than trying to go to one place and get majority of the services. That seems to be what I'm hearing. And I think it's about, the synergy of, don't try and do it all yourself. Great. Thank you so much for sharing those. And I think that those are the examples that we should pick on. And I think what I've learned is also, why aren't our downstream companies investing in some of our payment service banks or some of our technology fintech companies? That's a conversation for another day. So let's talk now. You know, Ashish, you have a lot of experience in this. And I think if we were to say, you know, looking at the success factors, if you were to look at the success factors as a recipe for success, right? What will be the ingredients of this recipe?
I would go back to the DTP, which is our the base or the core of our entire model. Distribution, have very, very agile distribution setup and go very deep and wide. Today at 800,000 points, out of which about 50-55% are direct and for about 40-45% are partner points. Broadly in the range of about 30-35% of my top line PNL or my throughput comes through my partner points, right? Second aspect, technology, keep it very, very agile, keep it very, very simple. The front end of your technology, the back end of your technology, the complexity of that, please don't expose it to the front end. We have a core banking system at the front end, but not a single screen or function of that core banking is seen by any of my merchants, any of my partners, any of my employees. We have built over 1,100 APIs on our mobile application so that it is a very, very simple, intuitive application that is there. So that's the fintech approach. You know, we believe that we're a fintech with a banking license. We're a technology company with a banking license. If you keep that in your mind, you'll always come up with technology innovative solutions to make it simple for that. Third aspect, and the mainstay of today's discussion in terms of partnerships, deal it as a philosophy, a win-win situation for both. You look at it today, we serve over 120 clients on cash management side. We have a platform. We do over 1,800 crores in terms of throughput on a monthly basis, where large companies in India who require to bury cash and concentrate on their core come to my points and bury that cash. That cash becomes the raw material for my cash out products. So those are the kind of synergies that you need to build. Having said that, please also be very, very cognizant of the fact that when you build partnerships, your alignment, long-term goals need to be very, very aligned as companies. The ownership of the customer must be defined at the first step itself, rather than becoming a point of concentration or a point of friction. Tomorrow, when the partnership blooms, the ownership of the customer should be referred to back what you decided on day one. Otherwise, you will always have a question mark in your head, who owns the customer for which product, and especially for the products which have high margins. So that is something that please take care when you're building up partnerships with companies which have similar goals as yours.
Thank you, Major. And I think one thing that I want to ask around this Netflix model and ownership of the customer is sometimes what we see is that the customers and the partners connect offline away from your platform. How do you ensure that you retain that connection on platform?
So what we've done is that the entire model is phygital, but the moment the customer, the definition, the customer touches any of our point from there, the entire transaction 100% digital, not a single piece of paper, right? Hence takes away the complexity. Number two, reach out to the customer. We reach out, we have a dedicated call center for our customers, dedicated call center for merchants, and hence we keep reaching out to customers with various means to give them another channel to access us. Thirdly, mobile banking application, which we push customers to keep downloading, though we know that would mean that he or she can transact at a lower cost than coming to an assisted point. But the longevity of a customer who is downloading that and the transparency is much more. So the multiple touch points that we give them, make sure that our connect with the customer is not through only one channel, through various channels that we have.
Okay, so you have a very high engagement with the customers and to lock them in because that gives them that confidence. So I'm going to sort of ask, break away for a minute and just ask some questions from the audience while we're having this conversation. So one of them, Darren, is asking, how do you manage power dynamics? As a fintech, we usually feel like underdogs and most of the regulations seem stacked against us. So when we look for partners, we're often at the losing end. Any ideas on how to change this dynamic?
So I would say actually in the context of India, the banks are the regulated entities and hence the cost of audit, risk, compliance is everything on the bank. As a partnership with the fintech, we look at ourselves as a fintech bank, and hence the philosophy is from there that, the more you work with startups, the more you work with fintechs, you would actually gain in a win-win partnership. But like I'm reiterating that, as long as when you regulated yourself as the bank needs to ensure that it safeguards itself, and the cost of regulation, the cost of compliance. And I'm not talking in terms of commercial cost over here. I'm talking in terms of the bandwidth or the regulatory compliances that the fintech partner needs to make need to be very clear on day one. If that's clear, we will always have a win-win situation. Number two, like I said, the ownership of the customer. And I'll give you an example. There are new banks in India. We started off with certain banks. When the customer matured, the bank at the back end believed that the ownership is there because the bank account finally resides with the bank. The new bank felt that I am bringing in the customer because the experience to the customer is totally given by that application or the new bank. So when the customer graduates to the higher level, who's going to own the customer? Who wants to interact directly? Or would you continue to interact through your partner only? These are various facets. If cleared out on the first day from a long-term perspective, will always be a win-win. Plus, what is the problem you're trying to resolve? Every scaled up business that we have today, thankfully, is something that we try to resolve as a major issue for that entity. Because we were resolving a problem, either bringing in money or saving huge costs for them, that is where the longevity of the partnership continued, and we did not have friction points in there.
Okay, great. Thank you. So Darren, I think it's really about the value in the partnership and ensuring that there's value on both sides and win-win in that sense. So it shouldn't be skewed towards any party in general. And then Henry Chukwu is also saying, I agree with you, Major. Customers, especially the low-income segment, do not like surprises, in this case on charges. Lack of transparency or disclosure is one of the major factors eroding trust in formal financial services. Then his question, how were you able to strike a balance in setting subscription pricing that is affordable and profitable as well?
So to this point, we carried out surveys. We saw what were the charges that would have got incurred if you were on a standard account. We carried out certain portfolio analysis, certain behavior analysis, went to the ground, and we said that we must have a product where customers should not feel that after 2 transactions or 3 transactions, the charges are getting incurred over and above the subscription price that we face. So we measure ourselves to say that only a very small percentage below double digits customers should be, which are high transacting customers, will pay over and above the subscription cost. The rest of the portion should be below that, which would mean that your understanding of your segment is good. First aspect. Second, naturally, we peg ourselves against competition in terms of regional bank, cooperative banks, and other banks in that area and see what service. But one thing in the last 5 years is that customers value service, and even in this segment are willing to pay a price for that service. And if you are growing, recently we increased our prices of our subscription product by about 10-12%. We did not see, we saw numbers for a couple of months, and now we are seeing an upswing, which means that the customer is willing to pay a price for it. And that's the real moment, because you can underprice it, you can overprice it, but the customer is coming back. And secondly, being a subscription product, I have as high as a 60% renewal rate in the second year, which means that there is an acceptability of the product and the pricing range attached to that. So it's a culmination of both these factors that, I would say one needs to look at when you're pricing your products.
Great. So it's really about knowing your customer and the segments you're trying to serve and managing the price points based on the customers themselves rather than fixing an arbitrary price. So there's a lot of research work that goes into each of these decisions that you make within the business. And so recently,
sorry, I just said, thankfully, we have a very strong business analytics team, and we invest in business analytics and data warehouse at a very early stage. And that pays us dividends because there is a plethora of data which is available, which you keep mining internally would give you all the answers. You really would not even need to go outside. Naturally, you need a ratification from customer service. But if you go deep down into your own data, 90% of the answers lie really within the organization and the data that you've already captured of your customers.
Great. So the whole idea of having your own data repository to be able to mine it and ask different questions and get the answers out. And that's a nice segue into our next question, because Nigeria recently launched an open banking regulation. And so Lanre is asking here, where does the ownership of customers and open banking connect?
So like I said, in India's context, the liability or the ownership of the customer rests with the bank directly. There is no, the regulator will not have it any other way. And that's the way banking works, at least from an Indian context, I would say. Now, when you build up a partnership, there would be either you have to decide that one size fits all, right? Or in our context, like we say, we have BaaS, which is the banking as a service. We have a platform, and domestic money transfers, micro ATM, AEPS, all these products, CASA account opening, cash management services, all of them built onto this platform. Now, one way to look at it is, can I be in every nook and corner of India? Yes, I can. We could have got 5 lakh points. I can be aspirationally looking at 1 million points in the next 12 to 18 months. But when you expand with partners, you provide a service, you need to have an equilibrium over there. And once those rules are set and a fair share of commercials between the two partners, you would find that this is the reason, this is the, I would say, that key to success. From an ownership perspective, the customer ownership needs to be defined on day one. The rules need to be very clear. If the fintech, I would say, if I'm working with if I'm the bank and my core segment is, like I said, between INR 1 lakh to INR 8 lakh, and I provide banking as a service to somebody who's going after customers who are beyond INR 8 lakh, then aspirationally, I should say I will always deal through my partner, but not try and contact that customer directly. Because when that customer matures, that neobank is going to feel that you are cutting him out. So those of the game need to be decided early. Plus, each neobank today or open banking platforms typically target niche segments. But at the bank, when you provide a service, you're not looking at the segment. You basically provide a fintech platform for them to into the banking environment. And hence, it is better to concentrate on your core, and the rest, let it be done with specialized fintechs and partner with them. To my mind, that's a win-win situation for both. So if you try to do everything on it, it has its own this thing. But as a philosophy, if you believe that I don't want to be a jack of all and a master of none, also an approach. But my advice is to go with your own core and partner with people with specialized cores.
Okay, thank you, Major. And I think that what I'm hearing is, we need to be very mindful that there's very clear boundaries in what we're trying to do today, and play to your strengths. We keep saying that, but can we practice it? And what you're saying is, as a bank, own the customer, then have available services that are not necessarily provided by you, provided to serve to your customers, and then that you get some money from there. But then again, manage and maintain the relationship and the engagement with your customers, so you retain them and own them as your customers in general. So the question I want to ask you now is really, if you had to pick 3 key things around choosing a partner, what will those key things be? Because I know that, in the work we've done, we've identified several factors. But in your view at Fino, what are those 3 key things you need to choose in choosing a partner?
Sorry, I was on mute. So to my mind, the first aspect to choosing a partner is the common philosophy or common goal. If it coincides with this thing, an example of that would be that if I am looking to my products as a bank to be reaching a far larger segment, then I'm looking for looking for players with large distribution setups. If I'm looking for adding products on my end and not manufacturing everything on more, and that's a philosophy we have internally. You cannot try and manufacture everything on your own, right? Insurance, go with the best insurance player. Where's the problem? Why do you want to build an insurance company of your own, right? Mutual funds. Why do you need to have a mutual fund company of your own? There are so many good mutual funds available. Leverage them. So in terms of that, the philosophy. What's the philosophy that you want to do? Distribution or a product or technology? Technology is again a great example. Typically, a lot of people will say, let's build everything in-house, I have full control. I would say go with the best kind of this thing, because what he or she can offer you is faster off the block. That company will get you faster off the block, more skill sets, better expertise, and a much better product than what you will do over a period of time learning and building it on your own. Second aspect I would say is the clarity of roles and what is the end point of that relationship. What problem are you resolving? If I'm resolving a problem, I know for a surety that this relationship is here in perpetuity and it will be a long relationship. If I'm trying to make an indent and get into a market and ride on some opportunity, which is a small-term opportunity, that relationship won't work beyond a point of time. And the third piece, the cost of reiteration, is that if there is a customer ownership angle to it, please be aligned to the fact that that needs to be defined earlier. And fourth and foremost is that when you look at partnerships, don't look at only one aspect of the partnership. You may be resolving a problem, but with every partner will bring in 4 or 5 different opportunities which the two organizations as a bank or as fintech that you can play upon and create more products for either the fintech's customers or the bank's customers. And hence, look at those 4 or 5 this thing, because sometimes you will find that within those 4 or 5 lies the high margin product that you can come out and is the winner for the day.
Great, great. So first of all, I think it's really have a purpose and that common philosophy that you both identify with. And that also goes a lot to do with the organizational philosophy and values in that sense. The second is clarity about what problem we're solving and where we're going to, and then roles and responsibilities. The third is the issue again about the customer. And I think the last is don't build a single product partnership. Now start to leverage the relationship and, innovate around the relationship in a manner that is beneficial to both parties and not just to one party. So I think in a way, it's really a different type of marriage where you sort of have conversations around where we go into, what are our goals and interests, and you align with them, but you're in it for the long haul in general. So finally, let's end with, you mentioned this issue about risks and, what are the additional risks and challenges that you've observed in working with partners, and how do you mitigate these risks and challenges?
So before I come to that question, one thing that we measure ourselves on our alliances and partnerships is the number of products that each of our partners does with us. And I've always seen the partners which are doing multiple products with you are the longest stay partners that you would have. So always advent to do more than 1, 2, 3, 4, 5, and that will add to the longevity of the partnership or the alliance. Coming back to your point in terms of, so I would say, even on Fino's own merchants or with my partners, because it is a widespread and dispersed model, which any large distribution setup would have, risk is something which needs to be foremost in your mind while designing your product. Please don't leave it only to the risk team to say this is the risk team's job. Your product teams need to think risk along with business when they're designing a process, when they're designing. And every aspect of your product has to be controlled through technology processes. The moment you bring in a loop of paper or an offline setup into an online flow, you will open yourself up to greater risk. Third aspect, please invest into fraud detection systems, into risk detection systems. We've invested very early into a system, integrated them with our core banking, so there is a constant feed of transactions going in. So to give examples, we used to find merchants transacting heavily at 2 o'clock at night and we used to wonder why. So we went out and looked and we found that these were merchants who were close to railway stations. Trains would arrive, people would come and transact over there. Now, can you map those merchants, treat them differently to the rest? Otherwise, at night, banking systems should actually not be working. There should hardly be any transaction other than online transactions, right? If you see a spike in a particular territory, great for business, 30% spike, 40% spike, super. Please think through it from a risk angle also. Is there something happening in that territory? Because 30, 40% spikes don't come in days and weeks together suddenly, right? We're in banking. Banking is serious business. A fintech approach doesn't change the mere fact that money is changing hand and you have the trust of the customer. And hence, all these velocity limits, your transaction throughputs, your daily limits have to be aligned to the target segment that you have. Because every now and then product managers would get carried away with the fact that, can I give something more? But you have to realize that this more, does the customer really require it? Because when he or she doesn't require it, there definitely you're leaving space for misuse. So it will be a fine balance. Invest in systems, invest in data warehouses, and control everything through technology. That's the only answer to all the things. And you still find people ahead of the curve with you, but don't compromise on it. Push your product teams to think risk along with business.
Great, thank you so much. And I think that's really a nice way to sort of segue, because it's really about don't take it for granted. You know, always keep your eye on the ball and really understand trends and patterns. Don't, try and understand and do a deep dive as to why this is happening rather than, oh, it's a good fortune. So I'll go back to one more question from Mr. Taiwo Joda. And Taiwo is asking, are payment banks in India also allowed to own or partner with agents to reach remote areas in a bid to strike the balance between tech and touch? If so, what is your organization's strategy in deepening this, and how has it worked for you? What percentage of your customer base is driven by or being served by your agents? Thank you.
I would say 99% of my P&L comes from the merchant listing. It's a completely asset model. We started with 423 branches. Today we have less than 200. And our entire philosophy is based on an asset-light, merchant-based variable model, where whatever we earn per transaction or per this thing, we compensate a fair price to the merchant. I would say the larger chunk goes to the merchant or the distributor on top of him, because the distributor controls the various sets of merchants in that area and looks after the cash management. Second aspect, other than the completely prepaid model. From a risk angle, it is the counterparty guarantee risk. Any money that the merchant collects on my behalf, he has to have equivalent money lying in an earnest money deposit account at the back end. Any money that the merchant pays out on the bank's behalf is paid out by him from his own money. We compensate him after a successful. So this is the biggest risk angle. I'm sorry, I'm coming back to the last one, but this is the biggest risk point in how to control risk in a wide and dispersed system. Aspects of operational risk, training, customer literacy, which I'm sure, which are ongoing processes and will continue.
Yes.
Back to your this thing in terms of this thing. So we invested into a merchant this thing. We invest into softwares like latitude, longitude. We have the exact latitude, longitude of every merchant of ours and where he or she is transacting. We know exactly where the white spaces are and guide our sales team to go here in these lanes, in this territory where we see we've still not covered. We try and keep about 200 to 300 square meter or to 500 square meter gap between two merchants so that adequate business per merchant. Because if you crowd them out together, you would be cutting into each other's business. They will always be unhappy with you.
Great.
If that's the philosophy, please stay with one. We started with a branch-centric approach, but within 3 months, we realized not working. And hence we shifted gears completely to an asset-light merchant base. And today, 99% of our this thing. Out of the merchants that I have, like I said, 55 to 60% of the merchants are directly run by Fino. 40-45% of them comes from my partners. 30-35% of my P&L comes through the merchants, and the rest comes from my own.
Great, thank you so much, Major. So I think it's really a blended approach. There's no one size fits all, but you can't do it by yourself. So work with different partners, using different engagement strategies around working with different partners. So I think we've had a very nice conversation, and thank you for sharing your insights with us. We hope that we'll begin to see a change in the partnership approach and partnership model, but based on those principles that you mentioned, which is the philosophy, the common goals and the common interest, the ability to innovate and co-create across with the partners as well. Thank you again, Major Ashish, and nice seeing you again. And we wish you a very Merry Christmas. It's early, but this is the first day of December, so we have to wish you a Merry Christmas as well, and see you again soon. Thank you, ladies and gentlemen. Thank you, ladies and gentlemen.
It's a pleasure, and wish you all a very Merry Christmas too. Thank you so much.
Thank you. Thank you, ladies and gentlemen, for joining us. I will now hand back over to our compares of the day, and we will see you all shortly. Thank you very much.
Ladies and gentlemen, welcome back. Thank you very much. Wonderful Fireside Chat. I think the meeting is so far and it's about to get more exciting. One of the very important parts of financial inclusion is essentially the strategic alliances and partnerships. We've been talking about that all morning long, and we're here for the part that I think is very exciting about. So we have a session entitled "Can't We All Get Along? Partnerships and strategic alliances for financial inclusion, identifying opportunities and critical bottlenecks." So the moderator for this amazing panel session with various stakeholders is Professor Olawale Ajayi from the Lagos Business School. Welcome, sir. And I'm going to let you channel the next panel session. So over to you, sir.
Thank you very much. And may I say welcome again to those of you who are just joining us, not only today, but perhaps for this annual conferences. And for those of you who are regular guests, it's great to see you once more. I hope it's been a very fruitful year. Yeah. Right. Okay. So today we're looking at strategic partnerships. And the question is, can't we all get along? And we want to identify critical opportunities, major opportunities and critical bottlenecks. And we have a very high-powered panel to help us go through this question, representing the various key points of the financial services ecosystem. First of all, we have Mr. Akin Onobolu, who is the Senior Manager Partnerships and Alliances with MTN Nigeria. Akin, you're welcome. Nice to see you.
Thank you very much, sir. Please confirm that you can hear me.
Yes, thank you very much. You're welcome. We have Dr. Paul Oluipe, who is the head of the Financial Inclusion Delivery at the Central Bank of Nigeria. Probably our own Mr. Financial Inclusion. Doctor, you're welcome.
Thank you very much. Thank you, Prof.
Right. We also have Mrs. Tomi Majakudumi, who is the CEO of Bankly, turning traditional forms into digital forms so as to empower those who are SMEs and the lower end of the market. Tomi, hi.
Thank you, Prof. Good morning.
Great to see you. And we have all the way from the Democratic Republic of Congo, Ms. Mami Kalonda, who is the CEO of Finca, a very influential microfinance institution, not only in DRC, but in all of that region. Bonjour, Mami.
Bonjour. Hi, everyone. Happy to be here. Thank you.
Thank you very much. And finally, we have Mr. Iniabasi Akpan. He's the country manager of OPay. He's not on the bike, so you're welcome, Ini.
Thank you, Prof. Thanks for having me.
Right.
I'm not on the bike. How are you so sure?
Okay, yeah, so thank you very much. That makes a panel. And, you know, we want to look at how we can get along. And I'm sure you guys will be able to help us look at this issue in a very practical and context-relevant way. Please, as usual, I'd like you to put your questions and comments in the chat box. I'd like to pick them up later on so that you can be a vital part of this panel discussion. But I would like to start the discussion right away, just clearing up some conceptual and business-related matters. So Akin, I'm going to start with you. MTN has a rich ecosystem of partners and collaborators, whether in industry or from the regulatory side, I think also consumers. So how do you define and conceptualize strategic alliances and collaborations? What would you say are the key enablers and inhibitors of effective partnerships, particularly among market players?
Okay. Good morning. Good morning again, everyone. Thank you very much for the question, Prof. It is indeed an interesting question. And the answers to these, I think we've heard from everyone who's spoken, from, I think it was Ivo Jenik, from Dr. Ihiana Cho, and also Major Ashish. But just to start off, indeed, we do have a large ecosystem of partners in MTN, cutting across the various segments that we serve, from consumers, enterprises, financial services, public sector, you name it. And one thing I find is that as you get into the business of value delivery, the lines between a customer and a collaborator start to blur. So you start to get to some of your customers being collaborators and partners, and then it starts to get really exciting. I think it was Ivo who mentioned when talking about partnerships that the big question is opportunity versus necessity. I see it along the same lines, but also slightly different. For me, in starting to build out and conceptualizing alliances, the word strategic, okay, yes, that's a really big word, but how do we close the gaps? So 3 things for me. How do we close the gaps in terms of our own organizational capabilities? What are things we're trying to do? What products are we trying to develop? What solutions are we trying to develop? What segments are we trying to target? All of these speak to the channels, the partnerships that we start to build out. If you look at the second bit of it, that will be outside in. So everyone comes, again, as I think Major Ashish said, looking at DTP, you want a partner who has a large distribution. We probably have one of the largest digital distribution networks in all of Africa. So we have a lot of outside in requests for partnerships which are coming in. So we start to look at them, see how they create value for us, if possible, how we can enrich them or how they can enrich products in our own portfolio. And I think the last of them, which I really particularly like, what I like to call the accidentals. You know what, as part of this conversation today, I saw Fino and an oil station. Oh, wow. That's just like mind blowing. That's okay. Yes, this is interesting. And those are the kind I call accidentals. So they come from anywhere. But for me, I think the key thing is that there must be some intention around it. It has to be intentional as an organization. And then if you ask me, what are the enablers and inhibitors to effective partnerships? I think for me, they come under 2 key things. So before I go into those 2 key things, some of the challenges that Dr. Ihiana had spoken about when it was referring to regulatory. He talked about internal reorganization, lack of succession planning, power tussles, policy discordance, and regulatory overlaps. And when you look on the flip side at what the inhibitors, what the enablers are, you start to consider what Major Ashish talked about, having a shared destiny, having shared goals. You know, you start to, for me, those 2, all of these come under 2 broad categories, control and trust for me. And while I was researching this topic, I saw really interesting, all of these hide under control and trust. Let's take it from an organizational perspective, first of all. So you look at an organization and you ask the question, how do we approach partnerships? How do the various functions within this organization approach third parties? Let's start with the word third parties. Do they look at them as vendors? Do they look at them as partners? Do your procurement team look at people as vendors or look at them as partners? Because they're treated differently. Whereas someone is trying to sell something to you as a vendor, with a partner, you're trying to build together. You start to unbundle that, you start to see a bit of control. So where is your organization leaning? So for me, I like to refer to it as the mindset of the most. Are most of the people, most of the functions within your organization thinking in terms of delivering value through partnerships? Are they just, well, they're just trying to do a lot of things with us and then we treat them as vendors? The next thing I like to look at, yes, is your contracting and governance. Again, following from control and trust. Where do you focus all of your efforts as an organization? Do you focus it on the lag measures, reliefs, termination clauses? What do I get if something goes wrong? Or do you start to look at it again, as Major Ashish pointed out, the scope of services, the partner's responsibilities, all of the things we're expecting, in which case it's a complete mindset shift. It's a complete organizational shift. How do we as an organization embrace this ecosystem of partners in an intentional manner? And I think, lastly, for me on this, in terms of these inhibitors and enablers, I would say I came across this equation, CRIS, C-R-I-S, so credibility, reliability, intimacy, and self-interest. And it says that the sum of credibility, reliability, and intimacy divided by self-interest gives you what you call the partnership quotient, the trust quotient. So where you see self-interest rising, then you see the trust quotient dropping. And when you see the self-interest reducing, you're starting to approach infinity in terms of trust. And that, for me, I think, are the enablers or the factors that enable or inhibit alliances and collaborations. Thank you.
Thank you very much. I think that was quite comprehensive. Dr. Paul, let me come across to you, because I think in the literature, one of the things that has been identified is that partnerships are not always hunky-dory. Sometimes, particularly in digital finance spaces, there may be some measure of arbitrage. And so people go into partnerships in order to quickly, leverage on technology. Given regard to the USSD dispute, is that what we saw between the telcos and the banks? And really, because of the central bank's role in promoting digital finance, financial inclusion, what would you say would be the effective keys for partnerships?
Thank you very much, Prof. Yes, initially when the pricing issues, the USSD cost issues were raging between banks and telcos, especially relating to the end user, charges that were the bone of contention in that period. Obviously, as a regulator, we had to play a role to try and arbitrate, to try and bring these two parties who are fundamentally sometimes, within different regulatory spaces, but basically offering a mutual financial service to an end user for financial inclusion purposes, especially relating to the USSD. So it was a thorny issue to iron out, which has led to a reviewed USSD pricing and also a new framework for pricing of USSDs, which allows for end user, charges. And then the banks and the telcos, even up to today, are still ironing out the thorny issue of, the backlog payments and, within that framework. And telcos claim, probably that banks have not made good on paying up, and then the banks, themselves have their understanding around what they should be charging, even after telcos had applied costs. So I wouldn't get into all the granularities of this particular issue, because these are both competitive issues in the landscape relating to banks and telcos and who's, but obviously in terms of partnership and trying to foster financial inclusion in Nigeria, the USSD system is a win-win for all, assuming that we have gotten a very level playing ground, a very mutually acceptable ground for implementing everything about the USSD. And if we're able to make this really take off and take off and scale, the partnership will be great, but we would suggest from a regulatory perspective, that all the parties to the USSD, especially the banks and telcos, require to look at, financial inclusion as the end objective and not necessarily, the profit-oriented aspects of it. Reason is that, if you look at the financial inclusion initiative at a first glance, it would basically dovetail or, kind of, accumulate into profit at the end of the day. Let me give a scenario. If you have 100 million adult Nigerians who are barely, minimally literate, who are very low income, who are not really high value individuals in terms of the resources that they can mobilize for banks, and they deposit 100 naira every day, or they make transfers or transactions of 100 naira on USSD system, and then the charges obviously would dovetail to huge volumes for for profit in terms of what the providers could really acquire in a day. So what we are saying is, we have a demographic that is ready. We have a massive demographic. We have a massive population. Partnerships could, leveraging partnerships could accelerate, uptake. Leveraging partnerships could help us really develop the USSD landscape. Everyone is looking at their own domain. At this period of time, is basically, as a regulator, we are calling for tough protection to be the lowest in terms of our considerations at this moment, if we are able to really scale USSD and if we're able to bring in unbanked adults into the financial services framework. So our part as a regulator is to provide a level playing ground to ensure that the costs do not in any way injure the consumers, and to also know that they are protected at every level of the transactions that they undertake. And that there is a redress mechanism that we have put into place. And that's why we have the Consumer Protection Department. We have a consumer redress mechanism, and we are ensuring that all of these, do not impact our financial system. Bear in mind, we are having what we call resilience. We want the financial system to be resilient. We want it to be transparent. We also want it to be safe and stable. And so from that perspective, our immediate imperative is to protect the financial system from all forms of issues that would make it, vulnerable. And that's why we are calling for, partnerships that are strong. We are calling for partnerships that are transparent, partnerships that look at everything. If you look at the open banking framework, for example, we have put into place guidelines to allow banks and financial services providers to share information using APIs. This is one thing, again, that would really, unfreeze the landscape, rigidities in the landscape, and allow people to really foster partnerships that are useful for our and beneficial to all of us. Thank you.
Well, thank you, Doctor. Very implicit, of course, is the fact that the regulatory intervention is very important. So the regulators need to get their act together, must be market focused, but must also be able to help the players look at the end game, not merely in terms of charity, but in the sense that a bigger market will certainly satisfy the profit objectives of both sides. Thank you very much. Let me move over to Mami. Give us an idea of what issues and perspectives are in your region, in DRC, for example. What are those inhibitors or enablers of partnerships? Do you have great partnerships in these spaces in DRC? Mami, over to you.
Yes, thank you. Yes, in DRC, we have a great partnership, because if I take the example of Finca DRC today is able to offer mobile banking, wallet to bank, bank to wallet, and the mobile application to customers, because we've been able to have partners, MNOs and other partners on the core banking system that can allow us to deliver to the customer what is needed, and also to give to the customer the product that they are looking for. So the partnership is really possible, and we really agree, and we know that in DRC, we are having issues except mostly on the connectivity. Connectivity is quite challenging and expensive in our markets, but we have succeeded to find out ways in order for us to reach there with the support of the regulator, as the professor has just talking about, because it was the first in the country, having MNO and the microfinance institutions putting together the products, serving the customers in order to increase the financial inclusion in the country. So it was the first thing to happen in the country. We're the first, and the central bank was together with FINCA and the MNO in order for us to put in place the product that could protect partners, but also customers. So since we launched our mobile product in 2017, up to now, the product is really working well, and the partnership is really possible. And what I can just ask, in the market like ours in Africa, we usually need to look on the win-win situation and also to see the vision. So when we are doing the partnership, we have to look at the vision. So do we have the same vision? Are we really partners? Because sometimes you can think that you are partners, yet you are competitors. And if you are competitors, it is difficult for you to succeed, because each one will try to achieve better or more than another. So in the financial inclusion and the opportunities that we are having, it is very key to define and to know the interests. Do we have common interests in this partnership? Do we have the same vision? Do we have the same social mission as well? Because if you don't have the same social mission, as the professor was talking on the regulator side, you may end up delivering product that will be very expensive for customers, and therefore the success of the product will be much not easy. So yes, in DRC, opportunities for partnership, they are there, and we as FINCA, we have tested it and we are working with it, and over 85% of our transactions, they go through our mobile channels, and mobile channels, they are not a miracle made by FINCA. It's a miracle made by FINCA and partners. Thank you.
That's great. I think there are three main points you raised there. That FINCA is able to participate, mobile money and so on. I think in Nigeria, probably that means that the regulator has to open the field for, it must be more market focused instead of carving up areas for particular players. You open up the space so that you can have more more competition. The other point you made is this social purpose. And I think that is something that Dr. Oluikpe also mentioned, that yes, there may be a profit element, but there must be also that social purpose. And of course, it was Michael Porter who told us businesses must create shared value. And I think that the third point, which was alluded to the question I asked Dr. Oluikpe, is that we cannot sort of outlaw competition even as we have strategic partnerships and so on. And so you talk about whether partners see themselves or collaborators see themselves as partners or they see themselves as competitors. Actually, they are competitors, but how they can then find that nexus that allows that partnership is something that must be both market determined and also regulator promoted. So let me go over to Tommy. What would you say are the major factors that trigger conflict and breakdown of collaboration and strategic alliances among players in the digital finance financial ecosystem? And are there any industry or regulatory initiatives that could be a panacea? Do we need more cluster-based thinking and strategy from the industry perspective? Regulators need to do something, or should we just let many players be there so that, you know, there'll be no dominance, no oligopolies, and people would strike out for the value for all, value for consumers?
Yeah, thank you, Prof. Good morning, everyone, or good afternoon. From my experience, I would say there are 4 major things I've identified as the challenges that come with partnerships. And then at the baseline is the willingness of both parties. It's almost like a marriage. It's a relationship. Both people must be willing to say yes. And oftentimes there is always there's usually a difference in power dynamics. Like there will always be a bigger player. There's sometimes, in my experience, a smaller, less powerful entity. So the challenge is usually, I mean, I would use Bankly, for instance. When we started out 2 years ago, we had no intention to build an agent network. So we felt similar to how the banks have partnered with existing agent networks. Let's do the same to be able to digitize the savings that we wanted to. But it's almost like approaching someone to help let you cross this bridge to get to the next side of the river. And it's looking at you and wondering, why should I let you cross my bridge when you just told me you're going to go and pluck that fruit? Why can't I go pluck the fruit myself, knowing you don't have a bridge? So oftentimes, you then have to go build your bridge yourself. So we need to first identify that, like Major said, there has to be a DNA change. There has to be a mindset. There has to be a shift in entities, both big and small, to say collaboration is the way to go. What can I get? How can I help you help me? And it's actually just the willingness to have the conversation, the willingness to say, this is at stake. Now, beyond that willingness is when they are willing to have this conversation, when they are willing to partner with you, then we then talk about equity. How are you going to have an equitable conversation? How are you going to ensure that the contract is not skewed in the favor of the person who has the higher power dynamic? Because oftentimes the contract, in partnership, there has to be equity. If there's no equity, then another person might as well be existing for the advantage for the other one. For lack of a better word, I mean, just the same way countries have their sovereignty, I'm looking for the word that identifies how a corporate is an entity on its own. So no matter how small you are not a subsidiary, you are not an appendage to another company. So if the contract is already skewing you as if you exist or your future existence is at the pleasure of this partner, then there's lack of equity. And we tend to find that a lot with partnership in this space. I mean, it could be nice to come here and say, oh, it exists, and like Mami said, but we also have to decide, we have to differentiate between vendors and partnership. If I get a technological company to help me build something or to help me, it's more like a vendor relationship. But when it's partnership, there has to be some form of mutual that we are generating from the market that is more sometimes beyond what I can pay you in cash and forget what it is. So that equity is a major problem. I think the third thing is, I like what Major from Finco said, which is, it said ownership of the customers. Now, when you lack equity, it sometimes doesn't matter who brings in the customers, so who is investing more, who is taking, because at the end of the day, you sometimes feel as at the flick of a finger. So there needs to be very well spelled out conditions on who owns the customers, or at what point is this transfer of ownership happening, and what do you get as a company when you transfer this ownership? I think the fourth thing is usually stability and control. And I'm talking about it from a different point of, at the end of the day, sometimes the entities are competing. So tying yourself to a specific partner based on certain conditions means that you're tying yourself to the challenges of that partner. You're tying yourself to the control of that partner. So giving an example, I remember when we realized that we needed to deploy terminals into the market, and we didn't even have the budget to do that. We kind of partnered with a bigger entity who could put in the cost to buy those terminals. However, we needed to process 100% with them, which was fair. However, what then happened is that if you're in a market that you're not the only one existing, that you're competing, all of the legacy issues of that company you're inheriting, and then you call yourself a startup who can move fast, who is agile, who could do better things, who could serve your customers better. Now you're inheriting the customer service issues they have because you're tied to when they can attend to you or tell you why something failed, to which you can then provide this resource to your customer. You're tied to pricing controls. So it then causes significant challenges with partnership. But I think to the question around what can be done, I think the first, like I said, is the willingness and the DNA should change on both sides of the end. But from a regulatory perspective, I mean, there have been talks in the past of sandbox when it comes to technology. However, sometimes this partnership requires a request for approval. It requires an approval from the regulators, which also gives, when the regulators are aware of both this partnership between this even smaller growing player with a bigger monster player, it gives some form of equity. But sometimes you request for this approval and 3 years, you're still there. 3 years when innovation has moved, when technology has moved, when you're talking, we've moved on from sometimes we're talking DeFi, we've moved on to things when people are talking of the NFTs and tokens and stuff. And imagine if you're trying to build a coin, like things have moved so far, you're still waiting on just this request for approval. So when it comes to what can be done, I think that openness to be able to speak to the regulators and say, this is what we're trying to do. Please just say, okay, consent, as long as the bigger partner who might be regulated by you have said, we are willing to go ahead with this. That also gives this growing partner the ability to approach you in confidence to say, this is what we're experiencing. How can you, or even to share knowledge with you. This is what we've seen from our pilot. This is what we're seeing that the consumers are behaving. And that's where I think can be fixed. It still sits sometimes with the regulators who are like the referees of the match, who can then help to balance the scale. Thank you.
Well, thank you. Very great stuff. I think maybe following from what you said, open APIs would be very good house infrastructure for weaponizing partnerships. Of course, I think the regulator really must, an industry must get to a point where open APIs are open. Not that they are open to a particular number of players or open to, in some degree. That's a great one. If I may then go on to INI, I know that I both spoke about partnerships, looking at the legal end of things. I'm a lawyer too, which is why in our research in the policy element segment, we talked about collaborations and strategic contractual alliances. Because yes, partnerships is even a legal form, but collaborations or informal collaborations or even quasi-legal partnerships go into the whole mix of partnerships in a larger sense. So what are the key challenges regarding collaborations with unit governments and consumers? And I believe OPE has a unique experiences and business model innovation ideas on this matter. So over to you, Ini.
Well, thank you, Prof, for that question. I mean, it's a very interesting question when you talk about our experience as OPE. So as we talk about financial inclusion, I think it's very clear and apparent to every one of us, I mean, especially players like ourselves, that government and ministries, departments, and agencies have a major role to play, if financial inclusion is going to happen, ultimately. So there are myriads of challenges, in trying to engage, and partner with various government agencies and even the government itself at the federal, state, and local government levels. But I'd like to first deal with the root cause, which in my opinion, is very important, and then now mention the specific challenges in themselves. I think when we talk about financial inclusion, it appears to be a central bank problem. the problem of the tech companies in Nigeria, and that I think is a major and a fundamental root cause on why we are still having lots of issues. Financial inclusion is not on the agenda of the federal and state governments and some of the local governments. I can tell you that, and we can see that clearly from some of the things that have happened over the last year or two when it comes to innovation and how we implement things in the market. So there's a huge disconnect because it's not on the agenda of the government. There's a huge disconnect. They cannot see the connection on what the social and economic impact of financial inclusion could be, to a state or to or to any government per se, So and that I think is actually one of the things that we need to be conscious about. As long as it is not on their agenda, it becomes a problem as you try to innovate and implement things in the market. So I mean, what is beneficial to the government are things like widening the tax net, and they cannot connect with how financial inclusion brings that about. How it boosts the economy of the state or a particular area. They are not able to connect with that. How financial inclusion makes that happen, and then also in terms of job creation. So as long as that they are not able to see those pieces, collaboration with the government is going to be a huge challenge. And I mean, so it always boils down to, it now results in, conflicting policies that come out from government, So when you say we want to do something, then you now meet stumbling blocks along the way that make it impossible. So for instance, ride hailing, which we try to embark on. Some of the rules were already apparent to everyone, but in several discussions that we had with the government, we all believed that, look, we're making some progress. And then all of a sudden, the dynamics changed and some new policy came out, and then it was a ban. Even though we had gone through a series of discussions with the government, around this, So that's why, as long as financial inclusion is not on the agenda, of the state government, and they don't see a connection between, how that widens the tax net and, brings and boosts the economy of the state, there's going to be a problem. And this does only really affect us as a company. I mean, if you take a look at, for example, at conditional cash transfers, you still can't understand why conditional cash transfers are still cash. We're still paying cash, especially when the platforms are there, the innovation and the solutions are already in place, and you can't understand why conditional cash transfers are still, are still cash based. So these are some of the things. So it results in them not seeing the big picture, and then also it results in some short-term thinking about how quickly we can get taxes paid. So you find out that letters get to you every day, at your door saying, hey, look, there's this tax you haven't paid, there's this tax you haven't paid. And for startups, that's a very, very big challenge, So I think that it's important that we understand that as long as financial inclusion is not on the agenda of state government, it's going to continue to be a major stumbling block, to collaboration with unit governments and all that. And then secondly, you talked about the consumers. On the consumer side, on the other hand, if you take a look at the consumer, I mean, as players in the market, we find out that the consumers in themselves want endless incentives. You have to continue to give incentives upon incentives to get them to, adopt this. I mean, so, the commissions have to keep increasing, or in spite of the fact that you have all sorts of issues that, you are building infrastructure, and you're not probably making a profit. In fact, most startups, I can tell you, are not earning a profit, and then they have to keep giving huge incentives and commissions. And a lot of people who are operators in the market, like the trade associations, don't understand all of these things. And so it's difficult to engage them. It's difficult to make them understand that, look, I mean, at this point, we're trying to onboard as many customers as possible. And with that, once people are financially included, ultimately everyone will have more access to financial services. They have credit history, and then ultimately it will be beneficial to the entire larger ecosystem. These are all the kind of issues that we face, and from my experience. And I'll give you a very good example. So, for instance, when we began to deploy POSs, in Nigeria, you'll find out that some of the consumers will not, in fact, most will not even meet the conditions at the terms. And even to get the POSs returned, in fact, some of them you probably have to write them off. You probably have to write off the POS because you don't get all of that investment back, because they just hold on to it. And in fact, when you send your officials to go pick up these POSs, they get harassed, they get beaten, they get, so we've had all sorts of issues, with how the consumers also see things, So those are some of the challenges that we face, as operators in the market, as we try to innovate and, foster financial inclusion as CBN.
Yeah, okay, thank you for keeping it real. So we see the challenges, which suggests that probably we've not made a good enough case for connecting financial inclusion to economic growth, economic inclusion to financial inclusion. Apparently, we're suffering the same problem. I think Dr. Paul mentioned that players have to see the end game in business development. Governments also need to see that. And it appears consumers also need to see that they must also collaborate in some way. However, in digital spaces, in technology spaces, the new business model is you give it out free, and then you look for how to monetize whatever your offerings are. The business model is that you keep adding, consumer benefits. And I don't know how much, I think some of what you have said plays into this new whole dynamic in the business environment, the whole issue of technology, innovation, and consumers. But let me go straight away then to Akin. So looking at one end of the consumer space, women, do you think that these partnerships, these collaborations have well served women, or do you think that as has been suggested, economic prosperity, economic survival is really more, has been sort of more critical? Looking at the fact that you have such a large reach, is there anything special you're doing for women? Can we learn about how we can better serve and reach women, or even use the women as key points in our value chain?
Okay, thank you. It's a good question. The first part of the question, do we think these partnerships have served or have better served women? I think I will answer that question. In consideration of the unbanked, 56% of them are women, 50% live in the poorest neighborhoods, 62% of them have primary education or less. So it's a scary thought. It's not something I had given a significant lot of thought to in the past. But then thinking about the question, you start to look back a few years ago. There were all sorts of conversations around child labor in supply chains. There were all sorts of conversations around sweatshops. So people started to boycott certain services, boycott certain chocolates. So the simple answer is that it really depends on who's doing what. Has it served women? Absolutely not. However, can it serve women? I think the answer is absolutely yes. So how did organizations in the past start to fix some of the ills which they found in their areas of business? So if you look at Tesco, for example, they started to look into their supply chain and mandate that all partners who provided them some service or the other complied with certain guidelines, certain global guidelines. And how does that relate to us? So again, if you look at big organizations like ourselves or even smaller organizations, we focus on the things that the government is asking us for. We focus on the areas of focus of the government. And I'm using my fingers in quote because then to register any company, they must have a TIN, tax identification number, they must have a CAC document, they must have certain things which the government has mandated that we accept. Now we come back to the question, who is enforcing or who is trying to drive a financial inclusion agenda? And how can that be built into other areas of business? How can that be built into how organizations operate, how organizations report? You know, that's looking at it from a regulatory space. Organizations like ourselves, we have a huge focus on women development, empowering women, breaking the glass ceilings for women. We're very intentional about that. So for me, maybe the next step is saying, you know what, in the organizations that we work with, in the large organizations we work with, we would like to start seeing some reporting on what it is they're doing for women, on how it is they're creating enabling environments for women. Again, just look at South Africa, for example. They have the B, it started off as BEEE. I think it's gone to be like 4 or 5 E's now. But if organizations like ours and others started to ask for a statement of commitment as part of that registration process to see gender equality, to see a lot more of inclusion, women inclusion in business, I think it will start to turn things around. And in the same vein, again, we look at the regulators, if they start to focus on empowering women, developing women, and building that into financial inclusion metrics, I think we'll start to see a lot of difference. So for me, I think there are two angles to it. Big businesses and the regulators are able to drive it.
Okay, so incidentally, I have a question here from Henry Chukwu, and he's asking to what extent does MTN, in your partnerships, consider how much value is offered to low-income consumer segments beyond the quick financial values it offers to your organizations. And don't forget, we're talking here mostly also about products, product offerings, and so on and so forth.
Okay, so I'm not sure I understand the question. Do you want to say it again?
Chukwu is saying that in filtering partners or coming up with partners, to what extent are you really intentional about what those partners offer to low-income customers?
Okay, it's a good question you asked. So I think we define those kind of slightly differently. So you look at mass market, you look at large volumes of people, high value customers, lower income customers. So your question in our partnerships, in our drive for partnerships, in developing partnerships, how much focus do we put on getting partners and developing solutions with these partners that speak to low income brackets? I think for me, it's more a case of how do we help our partners scale? And scale for me starts to mean, again, mass markets, large congregations of people, ability to penetrate underserved markets. So that for us is a huge focus area. But in terms of specifically defining it to segment low income segments, I would like to at least take that on as a personal challenge and see how we can start to look more at that. So thank you for that question.
Thank you very much. And I think that is keeping us on track, that essentially we're looking now at product innovation, value innovation, business model innovation that takes services to these, to the people who are not included. And of course, we've seen, as Tommy mentioned, we have the regulatory sandboxes, We have the open APIs, we have agent banking, we have PSB licenses, and you mentioned now that there's need to do a lot more work in terms of coming up with products, suitable products that are required and will meet the needs of this low income segment. I want two questions very quickly. First, I'll pivot to Mami, then I'll come to Tommy. Mami, it seems as you, based on your discussion, microfinance institutions are very active in Congo. As I did mention here in Nigeria, there's some segmentation in terms of mobile money and so on and so forth. What else do the microfinance sector, what else do the microfinance sector give to low-income consumers or customers in Congo? What type of products, what type of innovations are you coming up, or what are the likely trends? Perhaps we can learn something from the trends or even the needs that you see in Congo and in your region.
Thank you, Professor. For DRC, yes, microfinance are very active because our financial inclusion rate is very low, is below 2 digits. So as microfinance, so we've been trying in the last 4 years at the association level to work together and attract customers into the markets. Moreover, the conditions that we are having, political instability and COVID and so on. So what we have been putting in place is a particular product for customers. So we are having like a product. I saw someone asking a question on how do we serve customers in rural area. So in our country, almost everywhere, it can be treated as rural area because infrastructure is an issue in our country. So if you want really to serve customers, you need to think outside the box. See what is the format that you can do to lower costs and still be efficient. So what we have been doing in the country is to use the agent network system. Our agent network system, I think the first one was launched in DRC in 2011. And by the time it was launched in DRC, we didn't have any law regulating that particular aspect of agent banking network. But with the regulator and the financial institutions were like, since it's something new, let's agree, give the opportunity. The opportunity was given to Finca to start with the agent banking model. And as we are serving customers, we will learn in the process and the regulation will follow. So this is what happened in DRC. So we launched the agent banking network, and the central bank we had to give monthly reports on how it was moving on. Then after that, we moved from monthly reports to quarterly reports. And in 2017, just imagine from 2011 to 2017, that's when the central bank published the new regulation on the agent banking working system. So when we're talking about partnership, it is not only vendor, core banking, it is also the regulator. So we created that opportunity for customers to be served because the agent banking who are there, this is the pharmacy in the area where the customer stays. This is the shop that everyone uses in the area to buy their food or to buy something that they really need in the houses. So these are the people that we are using as agents. They are also partners. So this is a partnership that helps the financial institution. Instead of investing in the whole full branch, you just give a post device to that shop, and that shop starts to do cash in, cash out. And as we move on, we created a product around that agent banking network. They move on doing cash in, cash out. They also start opening accounts. This is to respond to the question on the rural area. This is how we are targeting that rural area market. Because in the rural area, you can't open the branch. It will cost a minimum $400,000 US. But if you're having an agent in that area, this is a shop that is known in the area. All the village, they know that shop. They trust that shopkeeper. So that shopkeeper is being used as an agent, and we give him opportunity to open accounts for customers that need to open accounts and start transacting in a financial institution. So what also we put in place is creating attractive products that can help. We're talking here about women, because women mostly, they don't use technology. They can have phones, but they usually give it to either the husband or the kids. So can you tap for me? Can you do this for me? But we've transferred our banking services on the phone, but we need to educate that customer. So we as microfinance institution, we are organizing trainings. So we have incorporated in our businesses financial literacy for customers so that they can know how to use those platforms, how to be able to use the product that we are putting in place. And if we give them that opportunity to know, they also come up with ideas on what they want. So most of the products that we are having on our mobile platform, they are really tailored by customers. Even to reach to the extent of opening account, they are like, you know, coming to the branch to open an account, maybe I'm not feeling comfortable. I'm seeing people speaking French, yet I can't speak French. So to be closer and to facilitate them, so we just give it to the agent who can speak the local language and open the account for that customer. So we try to be closer like that, listen to them, and also the regulator is very determined in the process, because if they don't open up, I work in a country where I work for 3 years. And for 3 years, I've been waiting for the central bank to give the approval for us to proceed with the agent banking network. And from the day I started and the day I left the country, I didn't get that opportunity to start with the agent banking network. So there is also that bit that helps us to build up products that can really help and can facilitate customers to have that buy-in, and also not attract them with bonuses, as it was said, because on the digital platform, if you attract a customer because there is a win of $1 of airtime, they will come. Then after that, they will not use the system, because what is attracting them is that bonuses that you are giving them. So what is key and what we have understood in the Microfinance Association is to make customers understand and also give them what they really need. Because if we give them what they need, they will continue using that account. They will continue transacting, and it will not be a dormant account. And business-wise, as you are getting more customers, as they are using your platform, as you are bringing in.
We seem to have lost Mami there. So let me turn, I think we have just about 3 minutes more, and I want to touch Tomi, Doctor. Okay, thank you, Mami. Yeah, so Tomi, just in a minute, how can we strike more beneficial partnerships between FSPs and consumers in Nigeria? And then, Doctor, we have the PSB licenses, we have the digital currencies. What are the implications for collaborations, partnerships, products, and so on? And then, Ini, beyond partnerships, are there other trends we should be talking about? If you just touch those in 1 minute each, then we'll be done. Starting with Tomi.
Thank you, Prof. To reiterate the question, you said, how can we strike beneficial
more beneficial partnerships between FSP and consumers? Yes.
Thank you. I'll say that the better relationship or the partnership is more around responsibility of the parties. Now, the responsibility of the parties and everyone doing what they said they would do or doing what they've promise to do. So from a FSP perspective, you're talking service delivery, you're talking data protection, you're just talking everything that the consumer needs to trust that you will protect him or her, you would make sure that you would also transparency, you would do whatever you promised that you would do. And on the side of the consumer is also just making sure that they take on every information that is necessary. I'm sure Ini can confirm how a lot of these consumers don't even listen to the password, don't use this PIN. You're telling them all the time, don't do this, don't listen. This is our only channels. They will fall for fraud. They come and blame you. They will fall for this. Meanwhile, you are saying this over and over and over and over again. So for me, in conclusion, I think it's the FSPs to stay and make sure they keep educating, they keep transparency, and they ensure that data and services are the quality that the consumer needs. And on the other side of the consumer, to listen and ensure that they are following through with all of the recommendations that they advise to protect them that the FSP is giving to them. I think that way we'll have a mutually beneficial relationship that serves both the consumer and the FSP. Thank you.
I think that suggests we need more consumer protection associations active in the space, recognized by regulators, and FSPs are also working with them because these are aggregators who can speak the language of the consumers. And Dr. Paul, yeah, so what are those implications? Are there upsides, downsides, PSB licenses, digital currency, you know?
Thank you very much, Prof. Obviously, we do have a proliferation of, several kinds of things that are digital, but it's good for the system. It's good to have much diversity than to have none at all. So, more is often merrier. So what we're saying is we have PSB licenses, we have eNaira, we have agents, we have mobile money licenses, and as they continue, obviously, operations and practices may overlap. It is not unknown to see that in our landscape. But what should happen is that, there should be partnerships and collaborations which will foster a form of reciprocity, mutuality, and expectations. Obviously, I'm sure you know what we call social capital, which is an economic concept where we leverage on assets, by mutually pooling, capacity together. And that's what we want to do in the financial inclusion landscape. It gives us the opportunity, to develop products collaboratively. And somebody mentioned the regulatory sandbox even. It gives us opportunity to collaboratively generate products that suit our landscape, suit our people, and people will also have choice, have diversity. It could lead to lower costs in terms of competition. Even collaboration is not necessarily a removal of competition. As we collaborate, we also, there's another concept, co-opetition, which is like you collaborate, you compete. And so we could all, generate a positive ecosystem where organizations, are really sharing capacity while the end users and the beneficiaries are benefiting from, continuously, crashing costs. That means low cost products, suitable products that are, basically meeting their needs every day. Thank you.
Thank you, Dr. Paul. I think this plays to one of the recommendations in the SOMR for this year, that perhaps we need to have a legislation, a central legislation that sort of is a framework for all the regulators to come together, ensures that regulators have, not necessarily single frameworks, but they discuss together. They have a one-stop, shop most of the time. Maybe there will also be need for PSBs to sit on the bankers committee. I don't know. These are things that directly in your purview. Maybe there is need for not just a CBN regulatory sandbox. Maybe there is a need for more collaborative sandboxes so that all regulators can play in one space, and players don't have to be going from one agency to the other and so on. So I think part of what you say and part of what others have said, including in DRC, speaks to that point. Also, the need for regulators to be more speedy, even as you assess those risks in regulatory sandboxes, etc. So I think maybe the last word will be over to Ini. You guys are sitting right in the space of the consumers, customers, the unit governments, and you're also very much into the innovation space. So what is it beyond partnerships, or what are those trends we should be looking out for?
Well, I mean, we've talked about partnership. Our partnership is actually is very key, like everyone said, to actually fostering financial inclusion and making it happen. But I think one of the additional things we need to do, I mean, besides all that have been said, is that I think we need to widen the discussion. We need to expand the discussion to now include, the trade associations and all of that. We need to be able to somehow get them involved in that discussion. And even also the state governments and some of the unit governments we're talking about, they need to be part of that discussion going forward. I don't know the kind of, I think so far from what I know, the existing structure only appears to be within a few stakeholders in the ecosystem. But we need to now make sure that we somehow integrate other stakeholders like the unit governments and the trade associations into this overall discussion, so that it now becomes it now begins to drive financial inclusion as a way forward to turn things around economically, and make Nigeria work. In other words, so it's very, very important that they get involved in that discussion. And so far, as long as they are out of it, well, it's always going to be a struggle to try to make them see the bigger picture of what all that the innovation that we are putting in place is going to do, in Nigeria. So that's just it for me.
So essentially, what you're saying is that collaborations and partnerships are actually the panacea, and these are collaborations and partnerships that really bring people together a lot better in terms of consultation, in terms of seeing, what's in it for them. The fact that collaborating, partnering together will actually work for everybody. But also there's a point that it's talking about products and services that meet the needs of consumers. And I think that that's another key point we need to. It's not just talking glibly or blandly about inclusion. It's about products and services that actually bring in those unserved, unserved or underserved, and also better serve those that are even served. And I think it also means that even regulators, as is very clear, there's partnerships on the regulatory end among themselves, and there's a partnership between regulators and players. And what you are saying is that everybody, including the consumer, including the unit government, must be in a better partnerships, better collaborations. And the idea really at the center of it has to be the consumer. And what are those products and services that will meet their needs? And talking about players or consumers, FSPs are, when you look at regulators, I think regulators should also think very carefully about how can we also serve, all other stakeholders. And I think that's really the key takeaway I have from today. I want to thank you, members of the panel, for the engagement, the candor, and the insights you have given to us, ranging from Mami, from DRC, and to Tommy, to Dr. Paul, Aki, and Ini. Thank you very much for availing us of your rich insights, and also to the participants. I'm sorry we couldn't do more than the questions that Henry gave, but I saw a lot of conversation going on there. And as our panel has said, partnerships, collaborations, strategic alliances is what will get us there. And let's keep our eyes on delivering products and services that meet the needs of the consumers, particularly at the lower end, because that will drive economic inclusion, will drive development, drive down the criminality, and some of the other things that we see. All done within a market-enabled framework, because as Dr. Paul says, you collaborate, you compete. Thank you very much for staying with us. All too soon, maybe we say, see you in another 1 year, but of course, you're going to see us in various other interventions from SIDFS through the next year, God willing. Thank you very much. Bye-bye. Au revoir.
Bye.
Au revoir.
Bye,
Thank you very
everyone.
much for the opportunity and
Merry
very well
Christmas.
done, everyone.
Au revoir, guys.
Thank you very much.
We're getting close to the end of the program, and the business day limited is a partner access conference. This means it's a leading provider for financial news and intelligence. This is established in 2001. We're just celebrating the 70th year anniversary in June, and without further ado, I'd like to invite Mr. Frank Ivory, Publisher and Chief Executive Officer at Business Day for the closing remarks.
Thank you very much for having me. Mine is a very simple task. The hard work has been done already. It's been an exciting day. I am very delighted joining this morning. And I like the international flavor, especially what we saw in the last session that was moderated by Professor Jai. And I'd like to thank the distinguished professor for moderating that session. Business Day is delighted to continue to partner with the Lagos Business School in conducting its annual sessions. I have found it personally very beneficial. And the focus this year has been on partnerships, leveraging partnerships. And I think that's quite important. I think that in Nigeria, there is always a temptation to be a bit what do I say now? To be defeatist, to think that no changes are happening, that nothing good is happening. But I think if we look back to the first, of these sessions that annual sessions that we've had, and between that time and today, we'll see that there's been some progress. At least when we started, the payment service bank licenses were not being issued, and we have seen licenses issued this year, or even in the last one, we've seen approval in principle licenses given to Airtel and MTN. Those are real big elephants in the room, and we expect that they will make a huge impact. I believe that as we continue to advocate for improvement in financial inclusion, in deepening financial inclusion, especially providing digital financial services to Nigerians at the bottom of the pyramid, that we must continue to talk about the role for regulators, the role for policy makers, the role for players in the sector, and indeed for advocates like newspapers like ours. How it is that we must continue to push despite the slow pace at which we're seeing progress, but we must never give up. We must continue to push. We see progress happen across the world. And I think for me, the takeaway today, and it's nothing new, is the fact that financial inclusion is not CSR. Financial inclusion is a veritable tool for engaging society, for development of society. And I think for me, that's quite important. And I like the point that was made about the correlation between deepening financial inclusion and also expanding tax revenues. There's absolutely no question about that, that as we deepen financial inclusion, as we provide digital financial services across the board, especially at the bottom of the pyramid, we are growing wealth at that section of society as well. And by so doing, preparing them, to make their contribution towards tax revenue. So I think for government, it's important that that point has to be taken on board, so that while they make policies, while regulators are working, that they do it in a way that it enables Nigerians rather than frustrate Nigerians to create more wealth, and by so doing, avail government more tax revenues. I think for me, that's all I should say. Thank you once again to all our wonderful speakers and moderators. Thank you to LBS that has, held on tenaciously to this work that they do here at the center. And I would say that Business Day will continue to take pleasure in partnering with the LBS for this. Once again, thank you very much to all our speakers, members of the audience, and especially our speakers from the diaspora as well. Thank you.